This video is a guide on what to do during a stock market crash and the reasons why the stock market could crash in the next 3 months. Hi, this is Mosh. I'm an amateur trader and investor. Anything I learn, I teach you guys. This video is for educational purposes only and not for financial advice. I'm going to give you guys the 7 reasons why I think the stock market could crash in the next 3 months and the 4 things you can do to manage that risk. We have already had some correction, but there could be further to go. So make sure you watch this video to the end. First things first, in a simplistic form, the stock market is run on 3 things: hope, fear and greed. The stock market crashed in March 2020 due to the pandemic, and that was out of fear. No one knew what was going to happen, and it's something new that's never come to market. And in that fear, people were selling, and selling begets selling. We'll come on to that later when we talk about margin trading as one of the issues. After a couple of months, we had hope. They started talking about a vaccine, started doing vaccine trials. So then we started seeing a recovery in the stock market. Then we started seeing the greed, and this was in the form, a lot of it was in the form of meme stocks. People investing in shitty companies, getting them to 10x, 100x, 1000x. It was ridiculous. And always remember, for you to sell something in profit, there has to be a buyer on the other side willing to pay more than what you paid. Let's start off with the reasons. The first one, which saw the most recent dip in the stock market, was the Omicron variant. This got investors worried because there could be another wave. The vaccines might not work against this new variant. Now, this isn't too much of a concern to me. I'm a scientist. I know that viruses always mutate. There's probably already a few more mutations out there that they've not yet found. And I think we're going to see more and more mutations as the years go on. It's something that unfortunately we can't stop. It's just the way viruses work. And because it's a worldwide problem, there will be worldwide variants. Secondly is ridiculously high inflation. Inflation is the rising cost of goods and services. Most world banks want inflation to be at 2% every year because apparently that's like a healthy rate of inflation. However, in the UK, the last 12 months, it was 4.2%. And in the US is 6.1%. And just think about that. If your wage has not gone up by 6.1%, if you live in the US, you are actually getting less money than you did the year before. Inflation is the killer of wealth. And a lot of people call it the hidden tax. Number 3 is the energy prices, or I should say crisis. In the UK, a lot of gas companies have gone bust because of the rising gas prices. And bear in mind, in March 2020, crude oil prices were below zero. How ridiculous is that? Now it's above $70. And I first started actually trading in oil, and that's where I made my initial money. I started trading at about $17. In hindsight, I should have held on because they were all leverage trades. I would be sitting on a lot of money right now. Fourth is the Federal Reserve. Now this applies to US companies. Initially, the Federal Reserve said inflation is transient, meaning basically it's only here for short term. But as time goes on, it looks like it's here to stay for much, much longer. Now, the solution to solving inflation is increasing interest rates. But if you increase interest rates, that stagnates the growth of economies. So they have to try and get a fine balance. Now, if they increase the interest rate too much, that will shock the stock market, which would cause a massive crash. And in my opinion, this is why it's not good to be all US stocks. If you just got all your money into Vanguard, S&P 500 ETFs, that is not a good thing. This is why I use a managed portfolio. What I do is I give my money away to professionals. They invest it for me. They invest that money in ETFs all around the world. So it's the basket of companies, not just US, in Japan, China, everywhere basically. And they only charge a ridiculously low fee of 0.25%. So that's 25 pence per every £100 you invest in. I done a whole video on them. Go give that a watch. And the best thing is they will give you £50 completely free if you use my link in the description box below. Deposit a minimum of £100 and you get that £50 free. Just bear in mind you have to keep the £100 in there for a minimum of 12 months or you have to give them that £50 welcome bonus back. And even with the recent correction, I'm still up just over 7%. Number 5 is margin debt. Margin trading or leverage trading basically is where you borrow the broker's funds to leverage your trades. What leverage allows is to maximize your returns. So if you've got a 3x leverage, you get 3 times the profit. If something goes up 10% and you've got it as 3x, that will go up 30%. Now, as well as maximizing your gains, it also maximizes your losses. So it works the other way too. As of October 2021, there was $936 billion worth of margin debt. So think about this. If a crash happens and everyone starts selling and selling begets selling, if there's a big sell-off, people's stop losses will be here, or people get worried and continue selling, and that cycle keeps going on. So who's going to pay that $936 billion worth of debt? 6 is the meme stocks and the crypto markets. Now, this is really taken on by more younger investors, and these are very highly speculative markets. If we look at Bitcoin's recent drop, so it got to a peak on the 10th of November of the highest was $69,000. Just recently, it dropped 39%. That's ridiculous. And currently, from its recent high, it's at 28.94%. What other asset in the world moves that much in a matter of days? It's ridiculous. Now, I myself was invested in Bitcoin, Shiba, and Dogecoin. I actually managed to make 100% return on all those investments. And you can watch my previous videos and look at the timings, and you can figure out when I bought them, and you'll see I always pretty much got the peaks. And the key thing to remember here is nothing goes up forever. There always has to be someone buying at a higher price than you did for you to make a profit. And with Bitcoin, people think it's going to go up exponentially. That is not going to be the case. Now, I do salute the hodlers. If you're a hodler, carry on hodling. In 10 years' time, Bitcoin, I'm confident, is going to be much higher than the price it is today. But in my opinion, I think we're going to see another crash in Bitcoin. I think it's going to go down to about $30,000. And the reason why I say that is if we look at the chart, there is some nice support around $30,000. It will retest that level. Now, potentially, more than likely, it will probably go back up from this level. But with Bitcoin, you never know. It could, if it breaks this level, then we're going all the way down. 7 is valuations. The valuations of some companies are ridiculous. If we take the whole S&P 500, forget Tesla and any other companies like Apple, if we just look at the top 500 companies in the S&P 500, and if we use a Shiller PE ratio, that is the price to earnings ratio, that gives us roughly around 38. Now, in its simplest form, PE ratio basically means it will take you 38 years to get your original investment back. And 38 years is almost like a lifetime. Recently, it was about 40. That is the second time it has happened in 151 years. Now, for it to continue going up, there has to be some money coming into it. Where is that money going to come from after everything is sold off? Unless these big companies are holding massive amounts of cash start pumping it back into the stock market, it's not going to come from the retail traders and retail investors, which is me and you. So what can you do? You have 4 options. The first thing is sell and take your profits, because those profits are guaranteed right now. So the value that you see right now, as long as the stock market is open, that is the price you can sell at, and that's guaranteed at this very second. In a day, a week, a month, even a year, that price might be completely different and you might be in a loss. 2, from my own research, and I'll link that video at the top, the most effective way to make money in the stock market is buying the dips. So when there is a big crash or there's a correction, you try and buy at the bottom. You might not always get the bottom, but if you get close to the bottom, then you're going to do well. Now, what you want to do is you want to invest a larger amount in the dip. So let's say you had $10,000. So what you'd want to do is when the first correction dip happens, you want to buy $5,000 worth. Now, if it does take another dip or there's another correction later on, you put the other 5,000 in there. You don't put it all at once. So what that means is you average down. Your average price is going to be lower than your first £5,000 invested. The third thing that you can do is something called dollar cost averaging. So what that means is you put a set amount every month and you buy a set amount regardless of what happens to the stock market. If it's going up, if it's making new highs, or if it's making new lows, you buy a set amount. That won't give you as much reward as buying the dip, but it's less risky. And overall, whatever happens to the stock market, after a while, your price is averaged along the highs and the dips. That is the most second effective way I have found from my own research to invest. The fourth and the last way is to give your money to a portfolio manager. This is what I'm doing with Invest Engine, and it takes all that stress and hassle away from investing, and it diversifies my portfolio. So I use it more as a risk management strategy. And remember, if you use my link below, you can get £50 completely free. If you want to watch my recent review on Invest Engine, give this video a watch. And if you want to see my research into the best investment strategies, give this video a watch.